Hello, welcome back. We're going to do things a little bit differently this time around in our market recap and look ahead. We're going to be focusing a little bit in the future and then working our way backwards. We're going to focus a little bit on data and then get into some markets and charts, things of that nature. I want everybody to write this down. Wednesday, September 17th. That is when the Fed announcement is going to come at 2 o'clock. And then obviously there'll be a 2:30 press conference. So September 17th, Wednesday, that is the day that everyone is expecting a 25 bip cut. That's the expectations. Okay. So let's just see what's coming down the pipeline data wise. We're going to focus right now just specifically on this week and this week alone. And then as we move forward week over week until we get to the announcement, we'll focus on the data that's coming. So I just want everyone to be aware of what's coming down the pipeline for this week. So on Tuesday, we're going to be getting ISM Manufacturing. These are all market moving events. So we have ISM Manufacturing on Tuesday. On Wednesday, we're going to be getting JOLTS information. Factory orders are coming. Then on Thursday, we're going to be getting balance of trade, import-export prices, initial claims. ADP will be coming out, as well as ISM services PMI are going to be coming out. This is all coming out Tuesday, Wednesday, Thursday, and then Friday, obviously, we get non-farm payrolls. So there's a lot of data coming down the pipeline for this week specifically. Now, why is this important? As we all know, the Fed chair has always said that the Fed is data dependent. A lot of this data will be factored into the decisions that they make coming down the pipeline on Wednesday, September 17th. So there's a lot coming. All right. Now, obviously, we're going to just jump in quickly to the S&P. Summer is over. Volumes should pick up. Liquidity should pick up. There might be a little bit of a vacation hangover in the first couple of days, but things should start picking up in terms of just volume and liquidity. Forget about direction, just volume, liquidity. However, there is a ton of data coming out this week. A lot of it is market moving. So don't be surprised if we're ripping all over the place because of this data. Now, obviously the S&P hit a new all-time high on Thursday. On Friday, we had a little bit of a retrace. Market is still looking great. We're still, from a technical perspective, and a technical perspective only, we're still holding where we need to. We're riding the 8-day. We're above the 21-day. We're train tracking 821.50. Everything is looking fantastic on the S&P side. There's really not much you could say from a technical perspective that there's any issues. So from that angle and that alone, market is going perfect. Earnings season is completely out of the way. The buyback machine is back on. So there is a bid under the market, at least for now. Let's look at the NDX. NDX is not looking as good as the S&P. Now, because the NDX, or tech in general, is such a huge weight in the S&P can only go so far without tech. So if tech starts to lag, then there could be issues in the S&P continuing to push forward. There are targets being ratcheted up. Some have 6,600, others have different numbers. If tech starts to lag, I don't see how the S&P is going to hit those numbers with power and authority unless something drastically changes. Okay. Now you have a day where tech took it on the chin relative to everybody else on Friday. Market is holding where it needs to, but there's definitely a little bit of a caution flag ahead. Let's look at the Russell quickly. Russell's looking better, really looking better. I would say for now, it's showing some leadership. Usually when you see the Russell leading like this, it usually signifies risk on. So there is a risk on factor into the market. Now the market always has rotation. So I wouldn't focus too much on day to day because there's always a rotation every day. Things are moving around. So I wouldn't put too much stock into that. However, I would keep the Russell up as a barometer to see if we're having a risk on or a risk off day. Granted, we had this igniting bar going back to August 22nd, market bull flag and then pushed up, holding where we need to. So the Russell's looking great. Let's just look quickly at semis. Let's look at the stocks. Semis not looking as constructive. They're holding and they're not collapsing. They're fine. They're just not leading. That's all I'm saying. So when semis aren't leading and you have NVIDIA and Broadcom, but NVIDIA specifically, which is the number one weighting, and you see that the sector as a whole is lagging, gives you a caution flag. Not go out and sell everything. It's just a caution. Now, a lot of times, because we're in September, there could be a push up. There's fiscal years ending, so a lot of people are kind of getting involved in to close out their years, get the market up for the mark, to get their books marked up. You get that kind of market activity and behavior. And then October sometimes usually ends up being like a little bit more of a harder month. However, you could have in September some tax selling, just again because of the fiscal year ending. Right, let's get into some of the names that have been participating and some of the names that haven't. So NVIDIA was obviously reported this week. Then the NVIDIA earnings were a dud. The market was expecting about a 6% move in either direction. It was about $11. It was a dud. There's not really much you can say about it. It was just plain and simple, it was a dud. And the reality is it was being bought up into it. So it made sense that unless they really knocked it out of the park, like really surprised, probably wasn't going to go anywhere. And it did just that. It didn't go anywhere. Let's just look quickly at Broadcom. Broadcom as well, holding where it needs to. They're not leading. The point I'm trying to make is they're not leading. So Broadcom's not leading. NVIDIA is not leading. If we look at quickly at SMH, like the stocks obviously, is not leading. Semis are not leading. It doesn't mean we're falling apart. It just means that there's a complexion change. How long does it last? It could be over by Tuesday when everything continues on its merry way. But for right now, what's led us to where we needed to go, or to get to these highs, so to speak, has been semi participation. Right now, the semis are not participating like you would like to see in a market that's sitting at all-time highs. Hence the NDX not sitting at all-time highs. Let's look quickly at some of the names. Microsoft, pretty much since earnings, we're at the 50. We bounced off the 50. We're holding. We'll see how long this lasts. Look at Apple. Now, Apple looks all right. I mean, again, it's not leading. It's just doing what it does, which is pretty much just kind of chop around, and has fits and starts of when it wants to go and when it wants to look good. And it just, it's not looking like anything you'd want to jump all over. Granted, if we take out this high at 235, we're probably making a run. However, something to keep in mind, and we'll talk about it as we get closer. On the event, usually the market buys up Apple into the event. We do have an event this September. When that happens, they usually buy it up. The event usually happens around 1 o'clock Eastern time. And as soon as that event starts, the market pretty much sells off Apple all day long. So it's one of those things where, to a certain extent, it's almost like a layup short. Now, granted, I wouldn't tell you just to do it. You have to use your head when you're doing this. But a lot of times on the event, Apple just gets sold off. Okay. Let's look at Netflix. We'll look at a couple names. Netflix, chilling, not really doing anything. Granted, it was summertime, so it's very hard to see certain things being explosive. A lot of that will change now that people are back. Liquidity is back. Volume is back. There should be some more movement. Google looks great. I would wait for retracements. I wouldn't be jumping all over this. Meta, they made that announcement on AI, and the stock has pretty much been a dud ever since then. Let's look at CrowdStrike. CrowdStrike was interesting because it had a massive recovery off of earnings. The only problem is that I like to use the 50% move rule. And whenever you see a market that's up, or a stock that's up on the igniting bar, you don't want to see 50% of it get retraced. Here you had a day where you basically had a retrace of just about 50%, a little bit more. If the market does not hold Friday's low in CrowdStrike and you're looking to be long, get out of the way. Your basic line in the sand right now is Friday's low, which is 420.39. We break that and you're long, just get out of the way. ServiceNow, also, looking good, banging its head up against the 200. We'll see if this holds a little bit more on shakier ground. Let's just look quickly at the Nicey Fang, see how that's doing. Doesn't look like the NDX. It's being propelled, not really giving you too much insight here. A lot of it's being driven by Google. Let's look quickly at Amazon. Amazon, they're holding, they're doing all right. I mean, stocks are not. A lot of times you need some kind of catalyst, and earnings is out of the way, and there really isn't any catalyst. The next catalyst that you have right now, besides data, is really the Fed. That's really what the next catalyst is, to propel us. You could see some book squaring where people start to get ahead of it and start buying. The only problem you have Let's go quickly here just for a quick second. So it could be a buy the rumor, sell the news type of event. Granted, we're about 2 weeks away from it, but it's just something to keep in mind. You might not get that chase for performance like everybody's expecting, because everybody pretty much knows that they're going to do 25 bips at that meeting. So that's basically to a large extent being priced in. And let's look at some ETFs and we'll wrap it up with that. XLE looking good, looking better than oil, honestly. Oil does not look like this. This is looking really good. The XLE really woke up. Now, granted, over here, you got to wait for a retracement. You cannot buy this here. You've missed it. So just wait for a retracement and then buy it. Don't buy it up here. Just wait. I would say probably around your 89, 88 bucks is probably a good spot. You get a retest of this breakout area, pull in, coincides with the 8-day, and then you can buy off of that. OIH also looking pretty good. Not explosive, but looking pretty good. XLE looks better. XOP also looks good. Again, you got to wait. Don't just be buying it up here. Wait. You've kind of missed the boat on this one. Wait for some kind of consolidation or retracement, something that you don't feel like you're chasing. Right now over here, you're chasing. Let's look at financials quickly. Financials obviously looking good. Market's expecting a cut. Financials are holding. They're looking pretty good so far. One thing I do want to bring up, which I think is important, is the 30-year, the yield on the 30-year. Okay. Right now, the yield is not backing off. Okay. It's something you should be paying attention to as a stock trader. Definitely keep this on your radar. Okay. Not so much the VIX, the 30-year yield. It's the TYX. Keep that on your radar. If this yield starts pushing back up into 49.60, 49.50, 49.70, and starts to go up, stocks are going to have an issue. Okay. Let's look quickly at a couple more stocks and we'll call it. Let's look at Palantir. Palantir, was the darling and then just kind of got smoked. It's holding the 50, but it's not special. Right now it's consolidating, so it's really not special. So I don't know how much you want to waste time there, at least for now. Dash also, it was special. Now it's just chopping around and not really doing much. Let's look quickly at biotech is holding, not really, nothing special here. And it's holding, they're holding. XBI, same thing, they're holding. Not really anything special out there. Something to keep in mind, we primarily focus on large and mega cap stocks. We don't really focus on small and micro. The reason being is we have the feeling of things that are cheap for a reason. So it's better not to be in those cheapies because they could hurt you. Anything under $5 isn't even marginable anyway, so it's not worth looking at. Really, you want to be in things where there's participation, whether it be institutional participation. You don't want to be in these cheapo names because they could hurt you really badly. And like I said, things that are cheap are usually cheap for a reason, so there's no real reason to be in them. Outside of that, we'll look quickly. I know a lot of people will look at this, the Dow. It gets quoted a lot. But the problem with the Dow and why the Dow is not a good barometer is it's only 30 stocks and there's no barometer to it. It's nothing. At one point it was this Dow theory, but it's 30 stocks. And the way that the calculation is made for the weighting, the way it's calculated is you take all 30 names, add them up, divide it by 30, and that's how you get the index. So, a Boeing, or let's just use Goldman. Goldman at $745 has a lot more quote unquote weight to the Dow than, let's say, a Microsoft, which is only $500. Now you're going to say it's a $200 difference. It is a difference to it. Or an Apple, or NVIDIA. It's $174. So NVIDIA is the highest weighted stock in the S&P and the highest weighted stock in the NDX. In the Dow, it's not as important as, let's say, a Goldman, just because of the way that it's calculated. Two last stocks before we wrap it up. I want to look at Cheniere. Now, Cheniere is interesting because natural gas is starting to poke its head up a little bit. Cheniere may break this consolidation if natural gas starts to go. It's something to keep on your radar, as well as Kinder Morgan. And this will be a direct plays on natural gas if natural gas goes. We talked about a commodity corner, silver, so let's just look at the SLV. This is probably in commodity land, if on the ETF side, probably your best place to be right now, hands down, is going to be the SLV without a question. So if you're asking which ETF is probably your best play right now, it's going to be the SLV. And then potentially the UNG, if natural gas starts to wake up, the UNG could start to get going. But really, your best place right now is the SLV, hands down. There's a lot of ways you could play gold. For more insights on gold, you can look at Commodity Corner for that. But I think right now the best place is probably SLV in ETF land. Thanks for watching, and we'll see you on the next one.